Hello, everyone. Thanks for tuning in. For those of you who don't know me, my name is John Flynn with Flynn Real Estate in the Niagara and Hamilton region. And today I'm going to talk about market crashes or will the housing market crash? Unfortunately, I'm not going to answer that question for you because I don't make that decision. But we're going to talk about crashes in general and what's happened in the past. First, I want to look at other assets and commodities and whatnot. And it seems one thing I've noticed is, stocks go up and down regardless of what kind of stocks you're into buying or watching or whatever it is. Bitcoin goes up and down. The gold and silver goes up and down. Everything pretty much goes up and down. Food or gasoline goes up and down. Food seems to only go up over time, but it's incrementally. Some points, sometimes it's quicker than others, but it does go down. The price of wheat and corn and stuff does fluctuate in the market, so I guess it does go up and down. Real estate only goes up. Many people actually have told me that it only goes up, and especially now, I can't disagree. It's only gone up. There are some times when it has gone down, but lately it's been going up. So I want to look at first of all, historical crashes, what happened and where they happened, and then just kind of where we're at now in the market. So first of all, I want to talk Canadian. We've had some smaller downturns, 2016, 2017, I think in BC there was some downturn. In 2018 there was a little downturn in Toronto and stuff with interest rates. So recently there has been, housing slowdown periods that a lot of people don't recognize or remember, especially in your local market. You might not have seen it, or if you're not in the business. But the big one in Canada was in the 80s, the late 80s and then into the 90s. There was a housing crash or slowdown. I don't know. You can look at it either way. Yeah. So I just want to pull up a website here. It's The Peak. I don't know who these people are, but they had some good information on it, and they had some key things in their blog or whatever it was here. And you can see the early 1990s housing market crash. Now, I started real estate in 2004, and looking back at sales, because I would look back at historical sales on our system, and you can see through the 90s, there was no price movement. It was flat or stagnant. And of course, I looked into it back then, and it was, the interest rates went up. Everyone knows about the 80s. When the interest rates went from 11 to whatever, depending where you are, 19, 21%. But here in this article, it's very clear, and it talks about what happened. Inflation in the 1970s and 80s increased the consumer price index. Of course, we all know the CPI now, right? To 4 times what it was at the start of 1970. Canadians concerned over rising inflation began to invest in the housing market. They regarded housing as both a hedge against future inflation and also an opportunity to use inflation to wipe out mortgage debt. So it was, and he talks about the psychology, right? So people use it as an inflation hedge, and they do that now with many things to hedge against inflation, where they buy assets, right? And because keeping cash is the worst thing you can do when inflation hits. So with that being said, so the 1980s housing crash was in Canada, or the 90s, or depending how you look at it. It was high inflation, rising interest rates, and it was a slowing economy also. But again, so that was that one. And then we get to another big one, the U.S. housing crash in 2007, 2008, and that. Everybody knows about that. That's been in the real estate or has paid any interest to real estate or markets, and that was an overall market crash. But real estate was the trigger, some people say, and that was in 07, 08. And again, it was low interest, subprime mortgages, and bad lending practices, really bad lending practices actually, that was responsible for that. There's a couple others, or one other main one I want to look at. And that was in Japan. So Japan, both the stock market and the housing market, it was the end of the 80s, early 90s, and the Nikkei or Nikkei, whatever it's called, They said it was about twice as big as a bubble as it was in 2007, 2008 in the United States. So it was like double that. So it was way more aggressive. So here you can see this graph. Who did this? Market Oracle.co.uk. It was hard to find information, especially recent. I couldn't get up like to 2021 for the housing prices because I wanted to see where are their prices now. But you can see here they had a 15-year bear market. So prices declined in real estate for 15 years after 1992 from their housing market crash and their overall stock market crash. And again, it was over speculation, low interest rates. It was the same group of circumstances that led to this crash. So, and there it is. And they say, I think it took like 15, 20 years for the prices to rebound to 1983 levels. So huge. Some people say it was a 20-year bear market in the housing market. And it did a big crash. You can see it did a big crash at first, and you think that maybe it would rebound, but it just kept going, which was pretty scary. Right now, if we look at China, so China has had, you've heard about the Evergrande. Well, I think that's more of the icing on the cake, but they've seen home prices decline for like the last 5 years or so. I'm not that versed on that market. But I did some research, and their housing market and their economy has been on the decline now for years. And this was 2021, November 2021. New home prices see biggest fall since 2015 in China. So they've been in a downturn in their real estate market for a while now. So next, I want to look at what have we learned from this history, and what can we take away from it with regards to housing. And I call it recent history because I'm not going to go back to the early 1900s or anything like that, the Great Depression and stuff. So the first thing, and this I'm going to link these articles here. Investopedia had a good one. The key takeaways from housing market bubbles and the history of them. So housing bubbles are temporary periods of months or years characterized by high demand, low supply, and inflated prices above fundamentals. These bubbles are caused by a variety of factors, including rising economic prosperity, low interest rates, wider mortgage product offerings, and easy-to-access credit. Forces that make a housing bubble pop include downturn in the economy, a rise in interest rates, as well as a drop in demand. So I think we can all agree on that, which I would say would be true. So how do they happen? And again, Investopedia here, they seem to have really good information on generalization of these things. And you can read here, like an increase in interest rates that put home ownership out of reach for some buyers, and in some instances make the home a person currently owns unaffordable. This often leads to default and foreclosure, which eventually adds to the current supply available in the market. So again, it is a supply and demand. So right now we have a demand, an over demand and an undersupply. But once the sentiment in the market changes, that supply will increase, which will reduce prices or reduce demand for homes, which could reduce prices, right? A downturn in general economic activity that leads to less disposable income, job loss, or fewer jobs available, which decreases the demand for housing. A recession is particularly dangerous. Of course, I agree. Demand is exhausted, bringing supply and demand into equilibrium and slowing the rapid pace of home price appreciation that some homeowners, particularly speculators, count on to make their purchases affordable or profitable. When rapid price appreciation stagnates, those who count on it to afford their homes may lose their homes, bringing more supply to the market. And I can't say homeowners are in their homes, they need somewhere to live, but once investors realize that they're not making the returns on these homes in the future, obviously right now they are, that's going to increase supply because they'll start unloading them. They'll say, this investment isn't giving me the return I want, let's unload it, I'm going to take my equity out and move it to something else. What they're going to move it to, who knows? Maybe it's something safer than real estate because real estate may be declining. But that has a snowball effect, especially when there's many investors in the market. They don't, people living in their homes, they can't sell, but investors can sell, and they will sell when they know, hey, I'm losing money. If I'm going to lose $10,000 in a year or 20 or whatever the case may be, I'm going to sell this investment. I'm going to take my profits while I can. I'm not going to let it decline. Some of them are in it for the long haul, but a lot of them will sell. One more thing I want to look at mean reversion. So yeah, mean reversion, it's a law of physics, but financial market use them too. So it says here, the laws of finance similarly state that markets that go through periods of rapid price appreciation or depreciation will in time revert to a price point that puts them in line with where their long-term average rates of appreciation indicate they should be. This is known as reversion to the mean. And of course, it talks about real estate. Real estate is subject to this too. So to put this in a visual perspective for you, I'm going to show you just a couple of graphs here from the Canadian home prices. And the first one shows the average and the HPI aggregate composite benchmark, and we use an index in Canada, and it's an MLS. It's based on MLS stats, and it uses I think it uses a mix of average and median depending on where you are in the country. But you can see they both follow the same trend. The average, since 2005, it goes up, and the HPI aggregate actually takes a little bit bigger trip up, or parabolic, some people call it. Now I'm going to add in a trend line, and I just placed this in here. This isn't based off of the specific numbers, but when you're analyzing stocks and graphs, you can add a trend line through the middle where it looks like the mean has been, right? You can see it going up and down over the years, but it always comes back to the middle on this upward trend, right? And this is where people say real estate always goes up. Well, over time, yes, it does. But you can see in 2016, right? It went up and then it came down at the end. And 2017 it went up and it came down. So, and even in 2019 it went down overall in Canada, and it still came back up to the mean trend line. And you can see since 2005 it's been pretty consistent, right? But here, of course, we are since after the spring or the summer of 2020, once things got back to normal with home purchases anyway, we've been on this uptrend. So if this trend line has any merit, you will see mean reversion back to this trend line. And we're in 2022 now, which puts the average house 575 approximately. So I'm not saying it's going to come back. It's going to drop 300,000 to that at this point. But right now we're at 750 average. I'm going to go with the average, the red line. And so yeah, you're looking at a couple $100,000 of correction. Will this happen? I'm not going to predict whether it will or won't. But just like if this market was down below this mean line or this trend line, chances are it is going to come back up sooner or later. So I do believe in monetary or fiscal trends, and that's what most people, when they're trading stocks, they're using trend lines. Not simple trend lines like this, but a lot of signals, and we're way above this. So it's just something to keep an eye out on. And just something to keep in mind. We are way above that historical normal rise, or rise in prices and house prices. So yeah, just keep that in mind. So I guess the takeaway from this video, or what I wanted to talk about, I don't know if the market will crash. I think that in general the economy will slow down, and people are going to tighten their belts, just like the Bank of Canada is, and many people are. When I go around, I was at evaluations last week, and in the same day I had multiple people asking me, what do I think of the market? And I'm like, what am I going to tell you? Yes, sell your house or don't sell. I always say it's situational specific. If you can sell and you're moving, you're going to sell, but don't sell it because you think it's going to go up or down. Unless it's an investment property, then it's not your primary home, right? Make that decision. But I'm very skeptical on making that call. But I am leaning towards, a slowdown in the housing market eventually. Once interest rates start to rise, if you've watched any of my last videos, that's what I always say. So Will the market ever crash? Again, the title of my video, it depends. It depends on, and from history, right? I want to look at history. And, you know, history doesn't always repeat itself perfectly, but there are trends in history, and we got to pay attention to them. Because it seems like real estate crashes or downturns are always linked to economic downturns and some other things, which are rising interest rates. It seems to have something in common with all real estate downturns. Consumer sentiment. Once people think, right now real estate's the hottest thing on the planet, of course people are buying it. But when people turn around and say, well, I lost a lot of money, or we had to sell and I didn't make much money, you know, the consumer sentiment's going to change, and other people are going to change, and they won't want it, as the demand will subside, right? And that brings me to the next point. Supply increases and demand decreases. And there was one thing I took away from an article I read. Supply issue will ease when demand and price growth does. So that's what's going to happen. Building a bunch of homes isn't going to squash demand. It's just going to fuel the fire, right? So demand has to ease for supply issues to get fixed. So back to what would be responsible for a slowdown or a crash. The slowing economy, right? This very, very big theme, like I just mentioned. It's a big theme. And this one, or this downturn, because eventually it's going to be slowing, right? Will prices go down? I don't know, but it will slow down the activity. But this time you have to look at investors will sell. In 2008, especially in Canada, it wasn't an investor-driven real estate market. It wasn't there was not nearly as many investors in it, which I think I previously stated too. Like, I didn't work with hardly any investors until after 2014, 2013. So investor sell-off will fuel a downturn. Again, taking their profits. Investors aren't going to sit there when they don't live in a house and watch it go down $100,000 and sit there thinking, well, it's going to go back up one day. No, they're going to say, I'm going to take my money and I'll buy it back after it keeps going down. And then for that one day when it does go back up, I'll have another house. I can make the same money back off it. So investors don't like sitting there watching themselves lose money, right? Unless I guess they have it in registered funds where they really can't touch it. So anyway, that's my thoughts on I guess the future, or people, the big question people are asking, and I get it all the time. And I get the other side of the question: will these prices ever stop going up? And other people ask, will the market ever crash, or is the market? Do you think it's going to crash? So instead of me just giving my opinion, I wanted to kind of give you guys some facts and take what you want from it, but just pay attention to those indicators or those things that will affect hot or cold real estate markets. And as always, if you have any comments, please comment below. I know that there's lots of opinions out there, and I like them, good and bad, agree or disagree. And like, subscribe, and I'll keep these videos coming. Thank you very much. Have a good day.